Hello and good evening, everyone, and welcome to the Digital Colloquium Surfing the Second Wave, hosted by HSBC India. We all have experienced possibly one of the most challenging years of our lives and continue to do so while adjusting to the new normal, both professionally and personally. The pandemic has shown us the importance of inclusion of socio-economic, environment factors, and why we have been forced to develop a fresh outlook. And I think this is all for good too. A fresh outlook, in our personal lives as well as how we evaluate our finances and markets. Integration of environmental, social, and government factors into our investment analysis has always been crucial. But these days, the way companies treat their employees and suppliers, for example, was stakeholders during the crisis and continue to bear a keen lens. Global economic market performance in the past few months have been relatively positive across the return investors or cyclical means of their views on how the sustainability of this global economic recovery would continue and the way forward. Let me have a brief introduction to our panel today. It is my great pleasure and honor to introduce our panelists. First on our panel, we have Mr. Nilesh Shah. Mr. Nilesh Shah, as you would all be aware, is the Managing Director of Kotak AMC, the fund house that has received the best rating by Navneet Munot in 2021. Nilesh is also a chairman of the featured by Mr. Munot over 27 years of research Next on our panels, we have Ms. Pranjul India. Prior to joining Pranjul Howard School. To invite our
Okay,
moderator for
friends, I
this
think
evening,
we are
who will
having an
help us
issue with
navigate the discussion with our.
may I request the coordinators to had a problem with the host for the evening and she could not introduce the panelists. But yes, I think the panelists are very well known and they need no introduction. I think I'll just refer to them. Mr. Nilesh Shah, MD, Kotak AMC, and we have Navneet Munot, again an MD, HDFC AMC, and we have with us Pranjul Bhandari, who is MD and Chief India Economist, Global Research for HSBC India. So I think the core point of discussion again for today, as the subject points out, the second wave, surfing the second wave in the digital curriculum. Well, it was scary. Last year it was scary, and this year, of course, we have seen because we had experienced the earlier wave, it was slightly consoling. But the fact that the national lockdown was avoided and the state level lockdowns were seen, it itself created some kind of uncertainty among the people, and how would it impact. So the markets have been really doing pretty well, but then let's hear it from our experts how it has been for the last 1 year, and probably what is likely to be going forward. I am sure each one of you have been eagerly awaiting for the context to be set in, and how the experts or the panelists really see going forward. So let me start with Nilesh straight away. Nilesh, can you hear me?
Yes, Karun, loud and clear.
Okay. Thank you. Thank you so much, Nilesh, for first of all for being here. And I want to straight away put you the first question on the global markets. And we have seen the global profits that have been rebounding sharply. The earnings expectation for 2022 have been ahead of the pre-COVID forecast. While inflation pressures are building and the policy debate has moved from a timetable on a tapering, quantitative easing, and the timing of the policy, do you believe the situation warrants turning points for the markets which have been making new highs? And particularly, Nilesh, this is a question which is there for everyone said, every investor wanting to take a cue from you. Should we take our money out or we should be holding in at this point of time? Over to you, Nilesh.
Thanks, Karun. It's a pleasure to be part of HSBC Digital Colloquium. If we look at central bankers around the world, they have been printing money, pumping liquidity, and keeping interest rates lower. In 2008, combined balance sheet of Bank of Japan, European Central Bank, and US Fed was $5 trillion. Today, it is $20 trillion. The central bank balance sheet has expanded not because they have accumulated foreign exchange reserves or both, but because they have monetized respective government's deficit. What is government's debt is in some sense surplus of consumers stroke corporates. In this environment, no wonder corporate profitability has jumped. In US, about 42% of unemployed people are getting more money sitting at home than what they would otherwise get working in, let's say, joint of McDonald's or KFC. Now, this kind of massive fiscal and monetary stimulus has created higher demand, which is reflected into inflationary pressure, which is also reflected into corporate profitability. Now, the question is, will government continue to maintain this kind of fiscal stimulus? Answer is no. Someday they will taper off. Will we see, tapering of some monetary stimulus? Answer is yes, undoubtedly. But the real question is that if by then corporate profitability has picked up the momentum and economic activity has, started growing on a self-sustaining basis, then despite all this withdrawal of fiscal and monetary stimulus, corporates can still deliver profit. Throughout the downturn of COVID-19 first and second wave, companies have cut costs, they have removed discretionary expenditure to the minimum, and that's why many people believe that profitability is sustainable. Now, the next question comes, if profitability is sustainable, then obviously markets will continue to rise with intermittent bouts of volatility. On a longer term basis, market is exact reverse impression of river. River starts on the mountain at the top, and then through various turns and it goes to meet the sea at the bottom. Market starts at the bottom and through various ups and downs, through various turns, continue to rise forward. Will the withdrawal of liquidity, raising of interest rates impact market? Of course, they will impact market, but will the impact be significantly high? Well, it all depends upon how do we see the impact on other segments where there is probably far more impact of this liquidity. Karun bhai, I just know the acronym NFT. I'm sure there are many young people who exactly know what it is. Now, someone ended up selling an invisible NFT for 18,000 euro. I'm sure those things will crash far bigger and far more than the listed equity. You have cryptos. Someone created a meme on crypto and that has some billions of dollars of valuation. There are 6,000 cryptos which are now circulating. I'm sure if liquidity is withdrawn, those asset prices will fall far more than listed equity. And then there is unlisted equity, where we are now learning that there's no measurement called price to earning. There's a measurement called price to loss, price to sales, and so on and so forth. And I'm sure Navneet will be able to add on that how do we have to relearn ourselves? Because in our, what we have learned in school and colleges and market is not sufficient enough to value this company. Now, I'm sure if liquidity is withdrawn, there will be bigger correction over there. So put all these things together, I do believe there will be tapering of financial fiscal stimulus, monetary stimulus, but the growth which is sustained by this fiscal and monetary stimulus will pick it up, and corporate profitability should remain more or less intact, little bit here, little bit there, but more or less intact. And there will be volatility in listed equity, but a bigger impact will be in NFTs, cryptos, and unlisted equity than listed equity. And you should make adjustments in your portfolio based on this theme.
Absolutely, very well said, Nilesh. I think the importance of diversification and each of the asset class, and that is very thing that needs to be looked into whatever asset portfolio that you build in. And probably hold your thoughts, Nilesh. I'll come back to you later on that. But let me put this question on the output gap to Pranjul. And Pranjul, you have seen a large output gaps, that is the potential GDP growth versus the actual growth, creating a big scope for catch up in certain regions. Especially we look at the EMEA, the Europe, Middle East, and the Africa segment, and the Southeast Asia. What are your thoughts with respect to India per se, with respect to the whole output gap scenario?
Yeah, thanks, Karun, and great to be on this panel today. So, look, it's a very legitimate question, right? There has been a pandemic, there have been 2 waves, there has been huge fall in activity, and output gaps are negative practically everywhere in the world. And as things stabilize, particularly after vaccination, these output gaps will close, creating what we call high growth, and things will look very good. We've already seen a little bit of it last year. After the big national lockdown in the first wave, there was huge pent-up demand. We're seeing a little bit of it this year, that after the local lockdowns of the second wave, there's again a pent-up demand. But I want to just sort of pause there and sort of ask a few questions. Number one, can pent-up demand last forever? By definition, it's a one-off. You were not allowed to buy something you wanted to buy for a long time. And as soon as, that is taken away, you go and buy it. You don't buy it forever. You don't continuously buy it. So pent-up demand by definition is is a one time. The other factor to think about is, what is really causing this global recovery right now? Other than pent-up demand, it's all of this liquidity, which even Nilesh was talking about, central banks putting global economy on steroids at this point. At some point, even that will hit its wall, and some of the central banks will have to retract, and even that could go away. My worry is, once these go, once pent-up demand goes, once the global sort of monetary tightening begins again around the world, then we will see the real scars that the pandemic has left behind. And I worry about 2 scars in specific in India. Number one, the health of India's banking sector. And number 2, the cost of inequality. Now, I'll just quickly go through the first one, which is basically the fact that we know that even before the pandemic struck, banks were rather risk averse, credit growth was low, and growth had fallen in 2019. I'm sure a lot of you recall that. Since then, banks have been able to raise a lot of money. Their capital adequacies have improved quite a lot, but yet, NPLs could be on the rise. We never see it in the year of the slowdown. We always see it a few years later, and it's something that we'll have to grapple with. If banks remain risk averse for longer, then credit growth will fall and potential growth will fall. That's one scar I worry about. The second scar I worry about is the cost of inequality. The fact that right now we are cheering formalization. It's a good concept. It brings in a lot of efficiency, but I'm worried that this is not organic formalization. It is post-formalization. The rich companies have gotten richer. The informal companies, many of them have got majorly disrupted and vanished. 80% of our economy is informal, at least our labor force is informal. If many of them lose livelihoods, see a fall in wages, have to sell assets, their demand will fall. And if their demand falls, then the prospects of the formal sector cater to countrywide demand will also dim over time. So these are 2 scars that I worry about, and I'm also going to say here that I worry that India's potential growth could fall by 1 percentage points post the pandemic. So before the pandemic, if it was around 6.5, it could become 5.5 post pandemic. This is my worry. But is all bad? No, not really. India is an emerging market. It doesn't just have monetary policy and fiscal policy at its, to deal with. It can also do a lot of reforms. And here I'm going to be focusing on 4 important reforms. My sense is that if it can get a couple of these 4 done properly, then over time, some of these scars can be healed and potential growth can, start rising back up. The first reform I want to talk about is the insolvency and bankruptcy code. It's if we can smoothen it, if we can improve it, improve the incentive structure, make it faster, then that can deal with a lot of the NPLs at banks. So that's one thing I'm going to watch. The second is social welfare schemes, both for urban and rural India. There's so much of inequality generated by the pandemic. We need that social buffer to keep, to protect the incomes and demand of the bottom of the pyramid. Number 3, how can you sustain social welfare spending? It can only be sustained if government revenues rise. So I'll be watching out for disinvestments or any kind of asset monetization. It's absolutely critical for the government to get onto that mind frame, of disinvesting, monetizing its asset, recycling its assets, and so on and so forth. And finally, moving from a thinking of import substitution to a thinking of export promotion. I think that is very critical for schemes like the PLI scheme, which has done so well so far, to continue to do well. The fact that we think about it as something that promotes exports rather than think about it as something that leads to import substitution. Whenever India has muddled up import substitution and export promotion, it has made a mess. Remember the 70s, remember the 80s, remember the 90s. We need to choose. One policy should have one objective. PLI should be focused on export promotion. If we can do that, it can be a big success. There's a lot of scope. Get some of these 4 done, and I think potential growth can rise back up. But if you don't, then I think we'll have to live with lower potential growth. That's how I see things.
Absolutely, very well said, Pranjul. I think the potential growth is really in this causes and concerns that you have clearly laid out in the 4: insolvency and bankruptcy, social welfare, government in revenue by way of this divestment, and of course the export reforms. Coming to you, Navneet, the global expansion phase normally brings in a strong growing economy, improving labor market, and the robust corporate profits. However, if one was to believe the historic pattern, the mid-cycle tends to deliver lower total equity returns to what investors earn during the recovery phase. Do you agree with that statement?
So talking about the global growth, right? So I mean, on the India's growth, what Pranjul mentioned about the potential growth rate over the next few years, my personal view is that I think there's a potential for a positive surprise and a negative surprise. But while talking about the global growth outlook, I don't think we are in a mid-cycle, Karun, because I believe that we are just entering a long cycle of higher than trendline growth. And let me explain why I believe that. So as a result of this biggest health and economic crisis in history, the way policymakers have responded globally, they have paved the way for a sustained growth. I mean, we're coming out of a decade-long deflation and entering a period of sustained deflation. What's different this time relative to what we have seen since global financial crisis is that so far it was monetary policy alone which was trying to support growth, but it ended up supporting asset prices a lot more than getting the reflation. This time it's a mix of monetary accommodation with strong fiscal spending with also a lot of strong growth enhancing policies. And Pranjul talked about the rising inequality, which has been a challenge globally, but this time we are seeing more and more policymakers trying to address that, which I think structurally will be very good for getting the growth cycle back. And this time, another interesting aspect is the innovations that have happened, which have got accelerated after the COVID crisis. So this is like a cocktail, which is very different than what we have seen in last 10 or 12 years. And that's why I feel positive about the global growth cycle. And you can add the pent-up demand. I agree with Pranjul that, that cannot continue forever, but at least that first part of next couple of quarters, a pent-up demand, and then added with all the other supportive policies should lead to a sustained growth. The other strong view I have is about the whole deglobalization. So moving from a world from a hyper-optimization to a lot more reliable supply chains. What it means is what I call the globalization of localization. that every country, every producer would diversify the supply chain, which means creating more capacity compared to where they are today. As far as the markets are concerned, of course, in valuations globally, a lot of this, what I'm saying, is captured. We are going to see a higher inflation and higher rates. QE will be tapered at some time for sure. But I think there is a part of market where, there is still a lot of value globally. If we see last several years, there has been a polarized market, but I think which is likely to reverse as the growth outlook undergoes a change. When we see a more broad-based global growth driven by the growth enhancing policies, infrastructure investments, investments to, the spending to create jobs, so on and so forth. So value and cyclicals versus growth and quality, small caps versus large caps, EMs versus DMs. I think that's how I see the markets kind of changing their leadership over the next several years.
Sure. Nilesh, coming back to you, Pranjul just alluded the fact of the weak banks, the health of the banks being weak. And also, I think you just heard from Navneet about the change in the policy measures. How dynamic the banks have been really to adopt to the changing policies. Have the current central bank policies changed materially versus the post global financial crisis, which are likely to have a big change in the profound implication that one should be aligning his strategic asset allocation for building a long-term portfolio? So how do you look at this particular aspect?
So Karun, this answer might be in slightly lighter way, but when we were kids, there used to be a serial called Star Trek, and the slogan was something like this, the punchline was something like this: to boldly go where no man has gone before.
No man. Correct.
So Bank of Japan is the Star Trek USS Enterprise of that serial. They are boldly going where no central banker has gone before. In the 90s, when Japanese economy came under pressure, they were the first central bank to pump liquidity, brought interest rates down to zero, monetized government debt. Today, Japan has higher debt to GDP ratio than any other, significant country in the world. They targeted policies to create inflation, and finally they ended up buying equities in Japanese market to an extent that today they are the largest owner of Japanese equity in the world. I think every central bank in the world is going to follow them. European Central Bank, when we were young in the market, we were told that they are having the DNA of Germany and they'll be inflation hawk. Then we got Mario Draghi, who said, I will defend Euro. And when asked how, by whatever it takes. Today, European Central Bank is monetizing deficit. It's buying more government debt than what is being issued by government for a brief period of time. And because of their miracle, a country like Greece is now, having interest rates lower than US. US Fed is no different. In 2008, they were pumping liquidity and cutting interest rates. In 2020-21, they are buying junk bonds, and I don't know whether they have started buying equity or not, but I'm sure that's on the card. So we have created a financial system where no one wants to take pain. No government, no central banker wants to take the pain. I think the origin of this lies in 1929 Great Depression. And if you read the book of that era, central bankers pulled back the stimuluses early and converted depression into Great Depression, which then took years and decades to come out. Now, to some extent, Second World War also helped in delaying the recovery, but be the case as it may be. The book of Lords of Finance does give some, some light on the mindset of central bankers, where they will be rather late than early. As we speak, US inflation number has come ahead, and I don't think so Fed is going to turn their stance to pro-inflation from pro-growth. They'll focus on full employment as much as possible. They'll focus on transient part of the inflation, like they talked about second-hand car and truck prices, which are gone up 87% year on year and raised inflation. So my guess is that central bankers are not going to change their stance until they are very, very sure of growth. And in that scenario, equity will continue to outperform fixed income over a longer period of time. Of course, there will be some small period where fixed income will outperform. There will be newer asset classes like cryptos, NFTs, which will emerge and surprise the investors from a growth or return or valuation point of view. And one will have to be really clear as to which part of investment is based on fundamentals, which part of investment is based on momentum. So one will have to play as things turn around, but I will still say that the first correction will happen in NFTs, cryptos, and unlisted equity before we see correction in listed equity.
Okay. So that's a cue that we will take from you. But so Nilesh, one thing you did mention in your initial briefing when you talked about the global markets and you referred to particularly the US, wherein you just said that the 42% seems to be unemployed and receiving the funds. What about India scenario? I mean, how have been the labor reforms, and I mean, how do you talk about the employment and unemployment scenario out here? I mean, you did hear Pranjul mentioning about the inequalities rising. So where do you see the labor reforms actually going in for India markets?
So we are very, very bad car drivers. In the car, and not that I know driving, so please take my comment at a book value, not at practical value. You have to keep on pushing accelerator to maintain the speed. When our car stops, we push the accelerator. And the moment the car picks up the speed, we believe our car is on a sustainable motion and we lift our leg from the accelerator. And sometimes we just end up pressing the brake so that the momentum breaks down. Our journey has never been 3 steps forward. It's always 2 steps forward, 1 step backward. Somewhere, what is right from an economic point of view gets completely swayed away by the need to be right from a political point of view. And this is reflected in our entire system. In Mumbai, people want metro, but they don't want to suffer noise during night time when metro construction is going on. We all want flyovers, but we don't want to suffer traffic jam, which happens when you're building a flyover. We all want construction of hospitals and buildings and infrastructure, but no one wants to work 24/7. No one wants to pay fair share of tax so that government can spend that money to build such things. The same mentality is witnessed in our labor reforms. A very minuscule percentage of our workforce is in organized sector. The rest are all in unorganized sector. Now one will imagine that we will liberate our labor reforms so that unorganized sector will be supported. But we are only focusing on organized sector, which is a minuscule percentage of total workforce, and we are believing that unorganized workforce doesn't exist. The exploitation of farm laborers is a real issue. The exploitation of workers in unorganized sector is a real issue. By creating labor reforms, by giving opportunity to hire and fire, by giving opportunity to employ contract labor, we will be able to unleash the potential of Indian laborers. The government did came out with a kind of amalgamation of labor laws into 4 major laws. That's a step in the right direction. But somewhere we need a Mahadev who can take the halahal of labor reform, store it in his thought, become Nilkant, and pass the amrut of better growth, more inclusive labor force to the Indian economy. We are waiting for that Mahadev in this Kali.
Sure. Thanks, Nilesh. So coming back to you, Pranjul, I think let's wait for the Amrit to pass down. But I think if you take a realistic optical view that suggests that interim lockdown measures initiated by the state governments could have a toll on the GDP projections for FY22. And you did mention about the fact that you see it a percentage lower. When given the facts to understand that various institutions have pegged India growth lower, what is your view on the forthcoming India growth strategy?
If your question is, how is FY22 going to look? So a couple of thoughts
Yes.
there. I think the direct cost of the second wave has been far lower than the direct cost of the first wave, simply because, the whole goods sector wasn't really shut down. Goods production, goods trade continued. Also, consumers, corporates, they all have learned how to live in the new normal. So my sense is that in the June quarter, we'll see, a sequential fall, which will be about half of the fall that we saw in the June quarter last year in the during the first wave. But my worry is that the indirect cost of the second wave could actually be a little higher. The fact that there is a little more uncertainty in the system this time than there was last time, and that could drag down recovery a little bit in the September quarter. That's the part I worry about. When I say uncertainty, the kind of things I think about is the fact that, at every point we all are worried about the third wave. We know that sentiments have already fallen quite a lot. In fact, this time, some of the data shows that sentiments are weaker than they were last time around. This time, we are seeing far more increases in input costs. Corporates are also wondering what they should do. Should they take a hit on their bottom line, or should they pass it on to consumers as higher prices? So these are some uncertainties in the system that are going to plague the September quarter, which were perhaps not there last time. So the recovery that I'm expecting in the September quarter, the Q-on-Q recovery, I think will be about half of the Q-on-Q recovery of the same quarter last year. So the fall will be half lower, but even the rise back up will be half lower, is how I'm thinking about the first half of the fiscal year. The second half of the fiscal year, I'm much more excited about, for the simple reason that, vaccination rates, hopefully will rise by then. Hopefully, we will be able to import a lot more vaccines by August, September. If we can go back to the 6.5 million jabs a day run rate, then by December, we would have vaccinated about 50% of our population, about 80% of our adult population. And I think that could spur some of this pent-up demand that I'd spoken about earlier, not just in goods, but also in services. So in a way, I see growth moving from uncertainty-led contraction in first half to vaccination-led exuberance in the second half. Putting it all together, my forecast is 8% GDP growth for FY22. It's lower than consensus. Consensus is closer to 10. And I think where I differ with consensus is the September quarter. I think it's going to be a little more weaker than a lot of people are thinking. A lot of people are just copy pasting last year's pent-up demand into this year's. Pent-up demand may not be that strong. One final word on that. Last year, once the lockdowns were called off, urban affluent went out there and bought all kinds of consumer durables, cars, furniture, electronics, and even houses. By definition, these are not things you buy year after year. They may not buy all of those things this year. Instead, because many of them are now vaccinated, they may move towards services. So I see urban pent-up demand move from goods to services. On the other hand, rural India may continue to buy goods. In fact, they may buy more goods this year compared to last year. Goods that make them feel more secure now that they've come out of the second wave, which hit them harder than the first wave. Goods like, two-wheelers or some repair work in their house, the things that make them feel secure, they may buy more of that. How will they fund it? I think they'll fund it with, agricultural wages, which thanks to monsoons over the last 2 years have remained fairly buoyant over the last 12 months. So a little change there. Urban won't buy goods, they'll buy services. And rural, who did not participate in pent-up demand last year, may participate into the pent-up demand this year round. That's some other thought. Finally, hearing a lot of murmurs about CapEx. Every second day I get a question from somebody, oh, is CapEx cycle rising? I think we get really excited about CapEx as soon as one or two companies announce some plans. There are obviously some enabling factors. There's a lot of liquidity. Commodity prices are up. So there is some commodity intensive sectors that are doing well. But overall, I'm not seeing that whole exuberance at a national level, simply because, capacity utilization is still weak, and that will take a lot of time to catch up. And that's when I think we'll start seeing a more sort of bigger participation of capex. So far our recovery will mostly be pent up demand, and that's generally the view of FY22.
Sure, thanks, Pranjul. So, Navneet, I think you just heard Pranjul about the GDP growth, and she has a forecast which is slightly lower than most of the institutions that have forecasted around 10%. But I think one key factor that really drives the whole GDP growth is the globally the oil prices. And what we have seen, as Pranjul did mention, the globally oil and gas companies have reduced the capital expenditure since mid 2020, maybe to curtail on carbon emissions or adopt sustainability. Do you expect a further up move in the crude prices as the supply constraints pick up due to the pace of vaccinations or spur in global demand?
Surely, oil is one part, and
Navneet?
I'll come to that. Sorry. Oil is one part, and I'll come to that in a minute. But before, just to take from what Pranjul and Nilesh Bhai mentioned about the labor reforms and the growth outlook. I mean, if you look at the countries that have been highly successful, they got three things right. Number one is the strong rule of law, property rights, and there we are moving in the right direction with all the measures that have been taken to do ease of doing business. The second is focus on education and innovation. There, I think India lagged behind very significantly, but I think the digitalization is coming as a boon. We're transforming from the most data poor society to the most data rich society in the world. And I think we can really leapfrog on the education innovation side. The third thing which is needed is a strong social security net. And that's where I think in last few years, we have made a very significant progress. And I call this India's universal basic income. India's UBI is a free toilet, a free LPG cylinder for the poor, a free toilet, free LPG cylinder, free LED bulb with a basic electricity, a Jan Dhan Yojana, no frills account with a basic debit card, maybe a Sukanya Samriddhi. I mean, variety of those things, Ayushman Bharat and Atal pension. And put together, that I think will go a long way in sustaining growth, which is a lot more equitable growth than most of the other countries in the world. Coming to the commodities, I agree with you. I mean, over the last few years, the supply additions have been very low, variety of reasons, which includes like lower growth outlook to environmental and social considerations. Now that the global growth outlook is changing, my sense is that after seeing a period of, I mean, the higher prices have to sustain for some time, because historically we have always heard large capacity expansions are announced when prices are higher than trend line, then vice versa. I mean, and vice versa. It should logically be other way around, but that's how it is. So I think this time won't be any different. A capex cycle will start when when people have the faith on sustenance of these prices and also on the growth outlook. So net, some of the commodities, I mean, you asked about oil and gas, but you can extend that to like all industrial commodities. They're significantly higher than the marginal cost curve. May have some correction, but I think we are in a positive cycle as far as commodity prices are concerned. They're also benefiting from a lower dollar as well as a lower cost of money. So I think over the next few years, if my call on global reflation is right, then we are in for sustained higher commodity prices.
Yeah, sustained high commodity prices. Nilesh, how does this go with the commodity prices going to the roof and likely to dent the corporate earnings? What sectors do you see
just to add
having
that point, as Karun, I mentioned that currently they are trading significantly higher than the marginal cost curve. There could be corrections on the way. I'm not talking about the short-term cycle, but I think over a medium term, we are in for sustained higher prices.
Yeah, so sustained higher prices. So I think, Nilesh, I think the question here is sustained higher prices definitely means corporate earnings, impacting corporate earnings. And of course, they're likely to dent a little bit, because if the margins are really squeezed, and what sectors are you seeing likely having these impact, and which are likely to be agnostic in terms of the price and volatility?
From a sectoral point of view, Karun, if you see, the world is kind of getting divided between old companies and new companies, companies creating disruption versus companies getting disrupted. And, when we say disruption, it's not related to technology alone. It's related to many such businesses which are using technology to create disruption. A logistics company today has to become a data company. They have to use data analytics to forecast what will be the need of the customers and create logistics solution. A healthcare company has no option but to manage consumer data within the regulations and leverage that data to ensure that they are able to provide proper pricing. An insurance company today is already moving in direction where he will learn from the chips in your automobile to give you customized package solution. A rash driver will get one premium, a conservative driver will get another premium. Now imagine an insurance company trying to create this disruption. Even in pharma, we will see tailor-made solutions rather than general solutions. So if I have to take a trend going forward, I believe any company which is disrupting the current business model and which is using technology to lower cost of product, to improve service, to expand market, to set up a trend, or to create a barrier so that their competitors can't catch up with them, that set of companies will continue to do well in real terms as well as in market terms on a sustainable basis. You'll have to really now look at the innovation quotient in every underlying company to figure out whether they will become like dinosaur extinct or they will continue to grow. Karun, you are on mute.
Sorry, I was on mute. Okay, thanks, Nilesh. And Pranjul, coming back to you. You know, you just heard Navneet talking about the central bank policies, and probably they are differing in terms of the fiscal and monetary measures that they are taking, and the growth enhancement measures that they are adopting. The way central banks are amending their policies, are we moving towards fiscal activism by adopting a cyclical or structural initiatives with greater use of automatic stabilizers and socially inclusive growth numbers?
Yeah, so look, the whole world is getting more and more adventurous by the day. Economists call it MMT, the modern monetary theory. But it's actually pretty simple. Doesn't need such a big fancy name. It's basically do everything you can to save growth. Governments are spending, central banks are printing. There is a sense that in the last crisis, the world put the brakes on easy policy very quickly, and that hurt recovery. Let's not do it this time around. So that's the whole thinking. And of course there are all of these new things that they are things like QE infinite that keep expanding your balance sheet, yield curve control. Like we are basically taking all of them to the limits. Now, what this assumes, the new MMT assumes, is that inflation, at least developed market inflation, is not a problem. But we already know that, for example, Nilesh had mentioned that in US numbers are rising. Some people say it's just base effects, it's just one-time readjustment cost. Time will tell, whether it is permanent or it was only temporary. But generally, the structure of the world has changed so much. Wages are rising in China. The world is becoming more protectionist. There is far more fiscal stimulus in the system now than we've ever seen before. All of this in general can lead to, medium-term higher inflation. And at some point, this whole MMT theory will have to think, pause and think, if they're becoming too risky or not. What are the implications for countries like India? I think there are strong implications. You see, some of the developed economies have followed, very strong institutions-led policy making for a very long time, inflation targeting, having specific mandates for fiscal policy, and maybe they have created some space or got some degrees of freedom to be adventurous, at this point of time when, we've been hit by a big pandemic shock. Some emerging markets don't, have the same credentials. They haven't, for example, India, good that we are an inflation target, a central bank with a strong mandate, but it's so new, we've not really championed it as such. So many emerging markets are probably like, too early in the system to become too adventurous or be allowed to become too adventurous by global financial markets. And they'll have to think about that carefully. There's a lot to lose. Countries like Argentina, struggle a lot with high public debt. Countries like India, they do see inflation come up, time and again. Most emerging markets suffer with very, very volatile growth. So these are things that emerging markets will have to take care of and not get too carried away. Also, even if countries like India decide not to follow very adventurous policies, unfortunately, they will be at the receiving end of adventurous policies around the world. Today, if Fed tightens, India will see some tightening happen, as a lot of money leaves. If the Fed loosens, prints money, India will see loosening happen as well as money comes into the economy. I think the best thing a country like India can do right now is to basically make their own domestic house very strong, very powerful, so that the externalities don't mess around with them too much. How do you make your domestic house strong? By having the right policies which promote, high and sustainable growth, keep inflation low and sort of constant, and also, have buffers, for example, high, FX reserves, which we now have. These are the things, the country should be focusing on rather than becoming very adventurous, getting carried away by developed markets.
Sure, Pranjul, keeping inflation low is something which is a challenge which most of the central banks are facing. And Navneet, I will come back to you because you did mention about a sustainable higher commodity prices. But CPI inflation has been running almost running higher than RBI's 4% target forecast for last 20 months, and other upside pressures could emerge in the second half of FY22. Taking core inflation at 6% or slightly higher, does RBI have any space to address the higher targeted inflation?
So, Karun, since the onset of this crisis, RBI has steadfastly been focused on ensuring financial stability, supporting growth, supporting the government borrowing program, supporting the credit availability, and has been happy tolerating higher inflation if it is transitory. And they've done a great job at that. And time and again, they've repeated that they will look through transitory inflation as growth will remain a priority for RBI or for policymakers. Now, commodity prices, particularly oil and metals, some of the supply disruptions we have seen, some of the food prices have gone up and some of the other commodities as well. Also, the higher margins by various players to compensate for lower volumes. And all of this has led to the higher inflation numbers that we have been seeing. At some point in time, I guess RBI would surely start withdrawing this stimulus. But my sense is that rather than RBI trying to target inflation, it would be better that this time it's the active policy and administrative measures that we take to augment the supply to ensure that we are able to contain inflation. And because this could be a long cycle of growth, and as Nilesh in some other context was mentioning about 2 steps forward and 1 backward. So what happens that in our growth cycle, within a short period of time, again, we hit into some roadblocks, we get supply constraints, and then inflation goes up, RBI has to hike the rates, and we just reverse the whole growth cycle. This time, I think if we want this to be a lot longer, to ensure that RBI doesn't have to put brakes, I think the policy has to work extraordinarily hard to focus on supply augmentation. But this is something that investors must need to watch closely, what happens on the commodities as well as inflation and the policy response to it.
Absolutely. I think, Nilesh, I think what Navneet did mention about the supply and the RBI continues to face with conflicting objectives on inflation, bond yields, and the rupee. This is supposed to be the impossible trinity. What is the desirable action that the central bank should take to counter the financial imbalance and to manage inflationary pressures?
So RBI's Ralph Nadal, Roger Federer, and Djokovic put together, for them, any shot is not difficult to hit. They can hit from any corner of the court and they can demolish any player. There's no central bank in the world which will perform like RBI is performing. And I quote Nobel laureate Joseph Stiglitz when he recommended that in 2008, if US Fed had governor like Dr. Y.B. Reddy, subprime crisis would not have happened. I'm sure Nobel laureate Joseph Stiglitz has similar word of praise for current RBI. We are blessed to have such an institution which is managing, record flows of foreign exchange more than $100 billion, and yet rupee is stable. It manages record borrowing program of the government 3 times more than the previous year, and yet more or less interest rates are stable. It manages massively disrupted economy on supply side, and yet inflation is well within RBI's comfort zone. For last 2 months, it's little bit on the higher side, but hopefully it should come down. They manage financial market stability. In both the waves, there was no impact on banking. We didn't see people rushing to ATM in the fear that banks will be shut and what will happen to cash. RBI's comfort was visible. They have ensured that market development continues to happen even in this time frame. And they have also supported growth through various measures. In fact, there is a consensus in which Pranjul will agree that our response to the pandemic is more monetary stimulus and far less fiscal stimulus. So overall, RBI has done an excellent job. And I think they should just continue to do what they are doing. They should not listen to outsiders who say you should be focused on inflation or you should be focused on just growth. RBI has developed a unique ability to manage multiple conflicting objectives in a very, very fair fashion. And they should just continue doing the excellent job they have been doing.
Sure. Navneet, coming back to you from the market's perspective, how should an investor cope up with their investment given the fact that the valuations are becoming or set to becoming a drag on the returns?
So on the valuations first, so I mean, there are 3 sources of returns in equity, right? One, you have the earnings growth, your dividend yield, and the change in PE. The further re-rating of market is unlikely. Dividend yield in India is very low, I mean, in relation to the overall return that you expect from equity. So bulk of the returns will be guided by the earnings growth there. As I mentioned that we are entering a new cycle of growth. And then we have discussed that about the global inflation. We can also talk about a couple of other factors which make us positive about the growth outlook in India, and also the return of corporate profitability. I mean, the mean reversion in corporate profitability, which has been substantially lower than the GDP growth over the last 7-8 years, I think it's likely to mean revert over the next 4-5 years. So I think a large part of the returns are going to come from the earnings growth, not from the P re-rating from here on. And that's how the investors need to moderate the return expectations. The other thing I would mention is that when you look at the aggregate level and you look at the valuations, but I mean, in statistics, a lot is kind of what is not revealed is more important. And there you need to look at that markets have been highly polarized. There have been a set of stocks which have pushed up the overall valuations. But if the growth becomes more broad-based and it's going to be a different type of growth than what we have seen over the last several years, then there could be another set of stocks that can do well going forward.
Mm-hmm. Sure. So there will be a lot of sector rotation that you see. Pranjul,
we are already seeing that over the last few months. Yeah.
Yes, absolutely. I think we have seen completely way out of sectors emerging and probably doing new highs. Pranjul, the government borrowing burden has been quite high. And first, do you expect any major fiscal slippage out of the second wave? And secondly, the bond buying program has always been elevated. How do you expect RBI to drain the excess liquidity, and what is your stance on the rate?
Okay, so look, on your first question on, will there be a big slippage in the fiscal deficit? The truth is, even before the second wave struck, the fiscal burden was quite palpable. The fact that in the February budget, they called for a 6.8% of GDP central government fiscal deficit. That was higher than expected. Overall, central and states would end up borrowing about 20 trillion rupees, in this FY22, which is a very large number. So all of this was already in the system, a lot of fiscal burden. But if your question is, has the second wave increased that burden? My answer is perhaps not, and for a few good reasons. Number one, tax revenues have remain rather stable, rather good, surprisingly stable. For example, GST And that is sort of, one reform that's silently happening in the background. The improvement in the GST reform, like the back end invoice matching, all of that has seen a lot of improvement, and keeping revenues fairly stable. Also, there's a lot of information sharing. For the first time, I'm seeing that between the indirect tax and the direct tax department. So if a small firm is paying a lot of GST, but not paying a lot of direct tax, a tax officer can go and ask the proprietor, how come you're not paying, this, and, try to explain what's going on. So this kind of thing is something which is a little new, but hopefully it has legs, and it'll support revenue side for longer. So that's one reason. The second is that the government hasn't really announced a major support package in the second wave. At maximum, it's only about 0.6% of GDP. So that does not lead to too much, slippage in the system. Third, RBI dividend has been much higher than expected. That provides some buffer on the revenue system, on the revenue side. But even if there is some slippage in the fiscal deficit, all of it may not translate into higher government borrowing, for the simple reason that the government has actually carried over a lot of cash from last year to this year. And that could fund some of the slippage in fiscal deficit, and all of the slippage will not mean more borrowing. And this actually brings me to Nilesh's point when he said that, Pranjul will agree with me that monetary has done more work than fiscal this year. It's true. Last year, financial savings rose a lot. Government was able to borrow a lot of money, but it actually couldn't spend that money. The government has implementation capacities. That's something we have to understand about India's expenditure side. And all of that money stayed in its account with the RBI and has been transferred over to this year, and could perhaps help fund some of the fiscal excesses this year. So yes, fiscal pressure is palpable, but it hasn't become worse because of the second wave. And I think now your second question, which is like, what will the RBI do? I agree with the impossible trinity. It can't do everything. It has to sometimes choose. Last year, it chose to buy bonds to help the government. It chose to buy dollars to keep the rupee from appreciating in the middle of the crisis. It infused a lot of domestic liquidity. It almost let go of its inflation target, which was okay. We were hit by a huge pandemic shock. This year, my sense is that they cannot ignore inflation. It is elevated. The drivers will continuously change. Last year was informal sector disruption. Then it was pent-up demand. Then it was second wave logistical disruption. Next, it's going to be cost push inflation. Drivers will change. But I think what I'm sensing is that inflation will sort of remain high at the levels it is, between 5.5% to 6%, which I think RBI cannot constantly ignore. This year, I think RBI will change focus. What will help the RBI is a BOP surplus, which is much smaller this time compared to last year. Last year, it was about $90 billion. This year, we are forecasting it to be about $25 billion, simply because the current account is moving from surplus to deficit, which means the RBI will not have to buy as many dollars. Not buying dollars, only focusing on bond purchases, will put a sort of a lid on domestic liquidity, and that lid on domestic liquidity will become a tool for fighting inflation. So yes, it will have to change focus, and it will find the space to change focus to inflation control this year. How will it go about? I think it will be very gradual. In the December quarter, we think it will start draining out some of the excess liquidity through tools like the variable rate reverse repo auctions and all of that. There are several tools it can use. It will start increasing the reverse repo rate gradually from 3.35 right now. Perhaps somewhere in early 2022, it will change its stance from accommodative to neutral. So this is the kind of trajectory we are thinking about. The final one is repo rate hikes. I personally don't think it's going to happen very quickly. I think the government, the RBI will wait for private capex to rise more sustainably. It's not really forecasting very quick repo rate hikes. The first one I'm forecasting is in the second half of 2022. So that's when the repo rate hikes will begin, as per my forecasts.
Sure. So it's a long time till the FCC, the hikes going quickly. Nilesh, to you on the FIIs flows, I think that we have seen touching close to a decade peak, almost 12% of the market GDP since we saw the last fall in March 20. What is your sense of the flows going ahead, looking at the market valuation as well?
So we have to thank China. They have been going after their technology companies. DDs raised money from American investors. Next day, China gifted them ban on their app management platforms. Alibaba, we saw what they did. So as long as China continues to mistreat global investors and their local companies, I think people will realize the importance of rule of law. They will prefer to invest in India where there is a rule of law. Companies can take government of India to the court and arbitration, and they will be far more comfortable investing in a democracy where there is rule of law. My feeling is that, if you see last 12 months across major emerging markets, India is one of the few emerging markets which has received flows. And our weightages in MSCI index and FTSE index has remained fairly stable. There was a fear that it will come down, but there was proactive action taken by the government and SEBI to ensure that our weights remain. I think as long as we can show growth, above average growth to our investors, as long as we can show governance to our investors. And if you remember in November when Prime Minister interacted with foreign portfolio investors, he gave a slogan of growth with green. If we can go on the quotient of ESG, I'm sure there will be a lot of foreign portfolio investors' interest in India. And we have to look at the difference between private market and public market. The public market flows are 10, 15, $20 billion. Private market flows are multiple times that. So I don't think so. We have to worry about foreign portfolio investors' interest in India. As long as we deliver growth, as long as we deliver governance, and as long as we deliver them return.
Absolutely, that's a very well said thought. As long as we deliver growth and the governance is in place, we should be really going well. So your last take, Navneet, on the market, we should be realistic as post a period when rising investor optimism has lowered the perception of risk and re-rated the risky assets. Your take on future of outlook on the equity market, which will be the closing remarks for the day.
Future of equity outlook. So, I mean, the legendary banker JP Morgan was asked, I think, some 100 years back on his outlook on the equity market. And he said, all I can say is they will be volatile. And volatile they have been, but over the last 100 years, they have also been the best performing asset class. But markets move like a pendulum. I mean, the investors move from fear of missing out to fear of losing money, then again to fear of missing out. And we see that greed and fear cycle. The optimism and the excitement that you talked about, I think we are seeing a lot of these millennials, first-time investors entering the market from India's perspective, which is good given the low penetration. But globally, I think Nilesh Bhai touched upon it. There are some signs of excesses in pockets of markets. For these people, Nilesh Bhai, I would say that for them, investing is another form of entertainment. And that makes me a little worried because making money has never been so easy. And that's what I think everybody should get concerned about. Though the optimism on India's market, the new investors entering, I mean, notwithstanding what can happen in the very near term, I mean, it's very difficult to predict the market. But I believe that I think aided by the global reflation, growth supportive policies of RBI and the government that we have discussed, all the reforms that have been undertaken, the global supply chain realignment, if you look at the India's leadership in the digital innovations, currently what's going on, the new investment in a real estate cycle, a new profit cycle, I think this is going to be a lot more broad-based rally than what we have seen over the last several years. Some of it is surely is in price, whatever I'm talking about. There are surely going to be some bit of risk as we go ahead. I mean, God forbid if there is a third wave, some of the other concerns that Pranjul talked about earlier in terms of maybe a higher inflation if RBI has to tighten, so on and so forth. But otherwise, I think over the next several years, my sense is that I think India can surprise on the upside as far as the growth outlook is concerned. But I would add that wealth creation is all about focusing on your goals, doing the right asset allocation and staying disciplined rather than taking the short-term view on where the markets are going to be in the near term. And definitely not what's happening in the whole, some of the other things that Nilesh Bhai has just touched upon. That's not the way to really create wealth over a long period of time.
Absolutely well said. I think diversification is the key mantra wherein you can do
having a good advisor like Karun.
And Oh, thank you. Thank you all esteemed panelists. I think it has been a lovely session. Vaccines have been discovered and trialed, but yet to be administered at a scale. The strength of and the pace of recovery of the prices of various assets class was more than extreme than anyone expected. However, we now look forward of a restoration of the global economy as really mandated by our esteemed panelists in the various steps which they have come out. Thank you so much, and it was really a wonderful talk having with all of you. This concludes the session for the day.
Thank you so
Thank you.
much.
Thank you. Bye.
Thank you.